So just to give you some background, I am technically a licensed agent, but I don't practice. I did do my license back in, I think, 2020. Um, my background, again, like I told some of you, was on the real estate development side. So I would raise money on the equity side and do projects like I was just mentioning to Mike. I would, buy single family homes and turn them into apartment buildings in Hyde Park. Um, yeah, no worries, Aaron. Nice to have you anyways. And that's kind of how my career really on the real estate side started. I was investing in real estate prior to opening my development company, and I got laid off from my corporate job around COVID time. So I decided, well, I have 2 kids to feed and not much else to do. So I might as well open a business now, better now than ever. So I really got into and immersed into the real estate network and real estate investors. And, that's one of the things I mentioned on Monday is getting around people that are doing the things that you want to be doing. And I'm really blessed to have a network of people around me now that are, super experienced, super successful. So that really is what propelled me into the real estate space. I joined a real estate network. Actually, I paid $30,000 to be a part of a network called Keyspire, and really it's just a Facebook group. So I had to I got laid off. I gave them all my money and then I got laid off. I'm like, oh my God, how am I gonna pay my bills? And so I took every opportunity, and because it was COVID and everybody was at home, they had a lot more time to connect. And I was on Zoom calls for like 10 hours a day, just really, figuring out what I want to do, how I'm gonna make this happen. And I ended up meeting my business partner that had construction experience. So basically what I was doing was finding deals, cultivating relationships with real estate agents, learning how to create pro formas, learning the business model of what we wanted to do. And ultimately every time we would buy a single family home, it had to be on this plot of land. It had to be at least, 50 feet wide by 100 deep, and we would build 8 units, and it was just like a rinse and repeat, right? Rinse and repeat. Buy a single family home, and in Hyde Park at that time, we were paying around $2 to $3 million for like decrepit, garbage. And then putting another, $1.5 to $2 million into the reno, and then we would refinance and lease the building and hold them in our portfolio long term with investors. So that's how I kind of got onto the finance space, because I had no choice. I had to finance these buildings. And all the, I would set up the limited partnership agreements and the corporations and work with accountants and work with, again, mortgage brokers. And a lot of what we did was we got private funds, because nobody wanted to finance that kind of stuff through the bank. It was a lot of rigmarole and all these kind of things. So I got familiar on the finance side, and I started building relationships and connections with lenders. And then people just started asking me for money, just because they figured, well, you're doing these projects, you must have money. Who's giving you this money? Here's Sam. And so that's kind of how I started the space. But I guess I'm highlighting that to tell you the importance of understanding the space that you're in, the niche that you're in, and how, for today's purpose, how private funds can serve your clients. Because it's, in my business, we always calculated interest rates on the private side. So people would be like, oh, are the interest rates affecting your business? Are they affecting your development? No, because we always ran our pro forma based on private rates, because we knew, if something ever were to happen, the worst case scenario was we go to a private lender. Yes, we're going to pay 10 to 12% on the financing, but if 10 to 12% kills our project, then that's not the project for us anyways, right? So that's just a little bit of background. And then, because of all those lender relationships, I started doing some private deals and just basically helping out friends of mine and people in the business, and people get out of tough situations. So yeah, that's kind of that. I'm going to share the presentation here. Let's see. So today it's going to be myself and Sam presenting. You know, Sam has obviously a ton of experience, way more than me. So we're going to just kind of tag team the presentation, and both share kind of our input. So, you know, before I get started, I think it's important to note when you're doing these, you know, you're getting leads, you're talking to people, you're getting clients. It's always important to do what's in the best interest of the client first. And I can tell you that, you know, a lot of the times it's not going to be a private mortgage, unless it's one of the situations we talk about. You know, this presentation is not meant to, you know, champion private mortgages, or, you know, go tell you, go do all the private mortgages you can. It is a great solution for a lot of clients. It is a great short-term solution, but we always have to have a plan. Because I've seen people, you know, I know people in the business that are, you know, they call them loan sharks and this and that, and they just continuously renew these people in these private mortgages. Why? Because they make the most commission. But in this industry, you know, it's such a, we had a couple of meetings yesterday with the different agents, you know, senior agents coming from different brokerages and whatnot that you know have are joining Kingsdale. And we know all the same people. Like, it's no matter what meeting we have, there's always someone that knows someone. It's a small industry, and the last thing you want to do is ruin your reputation just to put an extra dollar in your pocket. So it's really critical that you know, explore all options before putting your client into a private mortgage, and also critical to have an exit strategy. And the lenders will ask you, what is the exit strategy? Because, you know, the lenders that I work with, they're also not loan sharks, and they're also like, I understand this is a band-aid solution. How are you going to get them out? So make sure that you have a plan, whether it's selling the property at the end of the term, whether it's refinancing with an A or B, whether it's, you know, and this is part of your job as in my opinion, as a broker, as an agent, is to educate your client. Disclosure is everything. They need to know exactly what happens. What is the worst case scenario? What are the risks involved in doing this? You know, yes, it's expensive, but maybe that's the only choice they have at the time. But, you know, again, I'm going to say this 100 times, relationships are everything. And if your client really feels that you're genuine and you're trying to help them, and you're going to help them and not just forget about them in a year from now, and they're going to be calling you, you know, a week before renewal in a panic again, you're not going to be able to help them. So you need to have a plan. What's the plan for your client? And once you help that client, as we talk about, the referral sources come in, you know, oh, you know, Mike helped me. I was in a sticky situation. You know, Lexi got me a private mortgage as a band-aid solution with flexible terms. She told me exactly what I need to do to be able to qualify to get in with a bank at the end of the term. And sometimes it's going to take longer than a year, and that's okay. But as long as you know, have a plan, and this is how you're going to build your business, this is how you're going to build credibility, this is how you're going to build relationships and get those referrals, because they're going to know, you know, Abhinav was not about just making money. He really wanted to help me. He really wanted to make sure that, you know, I'm being taken care of. And he was so, you know, educated, and he educated me on things that I didn't know, and was able to provide solutions every step of the way. And that way, when that renewal comes, now you tell them, for example, okay, I have, for example, a self-employed, somebody that's self-employed. They're claiming next to nothing, right? Okay, there's a give and take here. You have to start claiming a little bit more. Get those invoices in. Start tracking your you know, the bookkeeping, and, you know, maybe their accounting is a mess. Why don't we clean that up? Right? Get yourself an accountant, get yourself proper bookkeeping, start claiming the income that you're actually making, because in the long run, yeah, you don't want to pay tax now, and I get it, but in the long run, you're going to continue to pay these high interest rates, because you can't have your cake and eat it too, right? Or let's work on your credit. Let's, you know, why with these private funds, let's pay off your, you know, your credit cards and this and that, and start building up your credit, start getting those invoices. So I think it's important to, educate your client, because some people really have no idea. They get themselves in these situations. We're here to, quote unquote, save them with these private funds, but very important to have a plan, an exit strategy, and be able to educate your client. So we're gonna do like a pretty, private mortgages 101, because I don't know where everybody is. We can continue having these conversations, but I want to start somewhere. So, forgive me if it's too basic, but we're just gonna go straight to the basics, right? So what is what is the overview of private mortgages? Obviously it's funded by individuals, organizations, and it's providing an alternative to bank financing. So there are private lenders that are, an organization, whether it's, they have a fund or whatnot, and a lot of them are actually just individuals. So private individuals, high net worth people, this is what they do. They lend out their money, and that's how they run their business. They make money off fees and interest payments, and that's basically how they run their business. So why would you put your client in a private mortgage? We're going to talk about that in detail, but ultimately it's quick. So again, if you're putting out a fire, if somebody's in a situation, there's a lot of power of sales happening now, and people wait to the last minute. They're embarrassed. They don't want to tell anybody. They don't want to tell their family and friends, and all of a sudden, they're two months behind on their mortgage payments, and now they're in a situation. And those files are really hard to, first of all, you need time. But most people, not most people, but most people in these situations just didn't act fast enough. They already knew what was coming. They could have maybe had another opportunity to do something, but now they're in this situation. So there's a lot more flexibility in private mortgages, and we'll get into that as well. Oops. So again, unlike traditional mortgages from banks or credit unions, private mortgages involve borrowing from private investors or private firms. So again, we're going to go over how there's flexible terms in private mortgages. We can have personalized agreements and faster approvals. So I've done private mortgages, and I'm sure Sam has done it too, where they close in 24 hours, and they need money yesterday. And we talked about this with Marani Law last week. She came in and one of the things, I know some of you missed that meeting, but it's recorded. One of the things that's really important is to have really good relationships with your lawyers. So we have lawyers, obviously, that we work with, that we're happy to share with you, that work with Kingsdale. And in these situations where it's dire situation, emergency situation, sure, maybe you're going to try, your client might need to pay a rush fee to the lawyer. However, there's they can close quickly and they can be approved quickly. And this is why also at Kingsdale we have an underwriting department. So if you guys do have private mortgages that need to be underwritten, obviously right now we're going to send them through all of them to Sam. And then Sam's going to send it to our underwriting department, and all of that is done in-house. So we have affiliations and relationships with private lending individuals that work directly with our brokerage, and we have a system that we have, that we've ironed out with them. So we know exactly how to underwrite, how to value the property, and ultimately get quick answers for your clients. Because a lot of these people, just even on the bank side, they're going to shop it around, but in these situations, typically it's going to be either a relationship thing, and they're going to trust Mike to do the job, and Mike, you're going to need to give them a quick answer, because every minute counts for these people. A lot of the times it's an emotional situation. It's the client's in distress. And a lot of the times you're also acting as a therapist for these people. So the longer you take, the more anxiety they're going to have. And, part of what your job is going to be is coaching them through, because it's anxious time, right? They know they're paying a lot of fees. They know they're paying a lot of interest. They don't know what to do. This has been a burden to them for a long time. and you're kind of the saving grace, and you're gonna tell them everything's gonna be okay, we're gonna get you a fast approval, and we want the lender to look at the file as fast as possible. So that's why it's important to have those relationships, and that's why, you know, there's a massive benefit, based on our Kingsdale group and the development side and the real estate side and all the relationships that we have with private lenders. That's a massive benefit to you as an agent, because a lot of brokerages don't have that. They're gonna say, go network and find your own lenders. Well, good luck. You know, because these lenders have a slew of agents calling them every day, and unless you do good business with them, I'll tell you right now, I have lenders, and if your name is not the top 5 names that they wanna do business with, your file doesn't even get looked at. And it's just a chase. Now you're chasing. So luckily we do have those relationships established for you already. And we'll be able to, you know, help you in-house with those kinds of files. So what are the advantages of private mortgages? Obviously, fast approval process. With the bank, it takes a long time to get an approval. These files can get approved within a couple of days, sometimes within 24 hours, depending on, you know, who the lender is, what kind of underwriting process they take. Again, if you're sending it out somewhere to somebody that doesn't really know you and you're testing a lender, those are always going to take longer. But if you have the relationships, especially the ones that we have, we can make a phone call. I have this property, it's 65% loan to value. This is the client. Are you good to go or not? Right? So flexibility in terms and conditions. So a big benefit to private lending, private mortgages, is that we have the flexibility to help the client. So I have lenders, for example, on a private mortgage, and I'll show you an example on a case study in a minute, but for example, you can prepay all the interest.
That's right.
Some lenders will let you prepay the interest. So say, for example, you're borrowing $100,000, the interest is 10%. They'll say, okay, fine, there's enough equity in your home. And you know, in fact, they might even lend you the 110 or whatnot, and then you'll pay the $11,000 in interest, and that gets taken off at the source. So well, the file goes to the lawyer, and in the conditions it says we're going to prepay all the interest. So now you've just accessed money from your equity and you have 0 payments. Now, having said that, not every lender will do that. There's a couple of reasons for that. However, a lot of equity lenders, you know, there's enough equity in the house, it really doesn't matter to me if you're making a payment or not. I do have another lender that, for example, they'll ask what the client can afford, because we don't want to put them in a situation where they're going to default, right? That's not what we're here to do. Most likely, if they're doing especially a second mortgage, they already have a first mortgage that they're servicing. And, you know, the second mortgage interest rates are obviously much higher than the first. So if they're in a situation, a financial situation or a financial crisis, chances are they can't make those payments anyways. So what's the point of giving them a mortgage and then they're going to default anyway? So on the flexibility side, some lenders, they want to see at least some transaction happening. So for example, you want to borrow $100,000 in second position, you know, your monthly interest payment is about $1,000, but your client can only afford $200 comfortably. We want to know what they're comfortable with, that it's eyes closed, no problem, the checks are not bouncing, it's going to be a successful transaction over the next year. So some lenders, again, not all, some won't consider this, but some lenders, and you have to understand your borrower in this case, if they're in that kind of situation, will say, okay, what can the borrower afford? And let's prepay the remaining interest. So say, you know, you're able to afford $100 a month. That's $1,200. Let's take that off the $10,000 that's technically owed, right? So you're prepaying, but now the lender's safe because he already got the prepaid interest, but he sees activity. There's activity every month. There's a check. The person hasn't disappeared. So it's just a sense of security for the lender as well. So we always try to get some payment happening, some transactions happening from the borrower side, right? Opportunities for borrowers with poor credit. Obviously, this is a big one, you know, and we'll talk about qualifications as well. If the borrower doesn't have good credit, most of the private lenders, they're not really looking at credit. Some lenders don't even look at credit at all. Some do, some don't. They all have different requirements as far as what you need to deliver with a package and a deal summary and etc. But most of the lenders are looking at equity. So, and because of the flexibility in the terms, they're like, okay, your credit's not great, but we've established that you can afford a $200 payment. We understand that you're gonna take this year to build up your credit. You might have to renew one more time, but there's enough equity for you to do that. So obviously that's a big one. And then, you know, customized solutions, meaning again, we can be creative as far as maybe you have 2 properties. Maybe I'm gonna tag one of the properties that you have. Maybe you have an investment property. Maybe there's not enough equity in one property and your loan to value is too high, but you told me you have a condo in Toronto that's almost paid off. Okay, let's tag that property, you know, or put a second mortgage on that property, or maybe refinance that into a first mortgage. So they're very flexible in terms of terms, solutions, and just being creative in general. So things will come up that other, you know, banks or institutions won't touch. A private lender can overlook a lot of those things because it's private, it's not regulated, you know, they can make their own decisions, they can self-title, you know, there's different things that they're able to, you know, overcome. And because most of them are really experienced, they'll look at the borrower profile and have an understanding, okay, I know this kind of borrower, I know the situation they're in, okay, we can waive that condition, right? Versus a bank is probably not gonna start waiving conditions left, right, and center. The risks, of course there are, of course there are risks to a private mortgage, like we talked about. A lot of the times, well, I shouldn't say a lot of the times, sometimes, you know, the lender, and this is why it's important to work with someone that's trusted, but the lender doesn't really care if you lose your house or not. They'll just continue paying you know, charging you all the fees, renewing your mortgage over and over again until eventually you run out of money. So there needs to be that financial education for the client, because what happens sometimes is, okay, I had a client, their house was worth $1.5 million. Their first mortgage was only $350,000. That's a lot of equity they could have potentially taken out, right? Because the lender would have gone to 75% loan to value. So they could have got like almost $1 million in hand. But this person's house was already in power of sale, meaning they don't have any money. They're not paying their bills. This person had a health situation, okay? So it was temporary, but they called last minute. We could have refinance them with the bank potentially, but because they had no income in the last year, that was going to be hard to do as well. Again, this person was, you know, not willing to share too much information with family and friends to get help. It's, you know, it's a bit of a trying time when you know you're getting statements from the bank, you haven't paid your mortgage now, this is the 3rd month in a row. And then this person was put in touch through a mutual friend of mine, and we had no other choice. So we gave this person, you know, just $100,000, just to give them a little bit of room, a little bit of breathing room. But you start giving these people, and this is again, this is where, you know, ethics come in and this kind of thing, because we could have given this person $600,000, right? We could have given them all the money they wanted, up to 75%. There was good value, the property was in a good location. But how is that serving the client? What are they going to do? They're going to feel like they just won the lottery and never, you know, never go back to work, never, you know, so there needs to be a little bit of common sense happening here when you're advising the client. We're going to give you $100,000. You know, obviously the client's going to ask for an amount, and this is where the education piece comes in. And then at least they have some a sense of urgency. Now this person's like, okay, I bought myself some time. I know $100,000 will last me maybe that year, but after that year, what are you gonna do? continue to take out more. So this year you're taking out 100,000 plus fees, plus interest. Now you're at 130,000, right? Because they wanted to prepay, they can only afford $150 a month, plus the fees get taken out at source. But if they don't have a plan in that first year, what's gonna happen next year? They're gonna have to borrow another 100. Plus the 100 that they have to pay out. Plus now you're paying fees on the 200. These fees are not cheap. The lender fees, the broker fees, the interest rates are not cheap. So first you wanted $100,000 problem to be solved, but next year, if you're not in a different position financially, now you just burn through that 100,000 for your carrying costs, your living expenses, etc. Next year, all of a sudden, you need another 100,000. But you have to pay off the initial 130,000. And now by the time the fees and this, now you're at 280,000, let's say. Right? So now your $350,000 mortgage on your property that's worth 1.5 million, you know, it starts to be now 700,000. Now you're in a much different position 2 years later, right? Now you're at 700,000. How long can you keep going until you lose your house? So that's not uncommon, right? So this is again why it's so important for you to advise your client and you know, tell them that, highlight the fact that this is a short-term solution. If you're gonna stay in private mortgages forever, you are going to lose your house. You will burn through that equity so quickly, and now all of a sudden you're spoiled because you're like, I don't have to go to work, you know, especially these people, and you'll see this, right? Like in not everybody, this is not the only reason people get private mortgages, but I've seen a lot of these cases where people are in power of sale, they don't know what to do, they're not great with their finances, you know. So this is what I try to reiterate to my clients and give them a little bit of education on the financial side and how to manage their funds, right? Obviously shorter loan term, so the majority of, I'd say like 99% of mortgages, private mortgages are 1 year term, would you say? Yeah, most. I think I've seen a lender that does 2.
Yeah, must be that.
But across the board, it's usually a 1 year term. So, you know, the again, if you want to renew, now you're paying the fees again, right? So due diligence on the borrower's ability to repay. Most of our lenders are equity lenders. Yes, they're going to do background checks and certain things depending on what the lender's requirements are. But they need to know that they're able to have some sort of you know, sustainable repayment plan, which we talked about. And then the risk to the lender is the market volatility. So, you know, this is why they do a lot of the lenders will do their own valuation. Even if you have an appraisal, sometimes they'll take a valuation fee, you know, a couple $100 just to verify that the appraisal is in fact accurate. They have their own system. Sometimes they'll pull a purview just to check if the values are actually what they say they are. But ultimately, you know, and I've been in this situation myself where I lent a borrower some money, and you know, the value dropped so significantly because of what just happened in the last couple of years. You know, I lent them the money when the values were at a peak, and unfortunately he went bankrupt, you know, when the interest rates started going up. So the property was worth 2.2 million. I gave them a second mortgage. By the time all was said and done, the house went into power of sale, and we could only get $1.4 million for the house. So guess what happened to my funds? Gone like the wind, right? So that's the biggest risk. And this is why, for the most part, these equity lenders, all they're really looking at is loan to value. Is the value actually there? What are the current market conditions, right? So all of these factors are going to be taken into account, because obviously the risk is the lender losing their money. So when do we consider private mortgages, right? So non-traditional borrower profiles, again, people that are self-employed, they're not claiming any income, you know, short-term solution, maybe they bought a pre-construction Oh, is there a question in here? Mike, if you have a client that comes, so Mike's question is, I'm a new agent and can't do private, what are my options? Sam is your option. So anytime you have a client, anytime you have a client and you think that, you know, they're not gonna be able to qualify.
Yeah,
call
working
Sam.
with a broker.
Yeah, so you can work with Sam or a senior agent, and they'll be able to guide you through that.
Okay, thanks.
So it's still important to know that these are an option, right? And then you can pass them on to somebody that can actually assist you in doing that. So again, a lot of people won't qualify for an A or a B, again, depending on their situation. I had a client that had to, they were going through a separation or a divorce. They wanted to keep the house, they had to pay out their spouse. And they had enough equity to do that, but because, you know, the equity was, they had so much equity, the bank would have never approved that person for that amount to pay the other person. So they got a second mortgage, this person was making good money, they prepaid the interest, and then a year later, they refinanced again with one bank. When the luckily the value of the house continued to climb, right? Again, quick financing is just a quick solution. It's a lot faster than going to the bank. There's different, and you'll see these different situations where these people need money relatively quickly, so we can get them quick answers. And then creative financing, again, we talked about interest only payments. So all of the private mortgages, you're only paying interest. You're not ever actually paying down the principal. So we have a lender that has a really good, you know, interest rates. They have really cheap rates. And sometimes it's even cheaper than, well, I shouldn't say sometimes, almost never cheaper, but you know, because you're not paying the principal and interest. We have a new lender, Sam just did a deal at 6.5%.
Yeah.
6.5% interest.
They're cheaper than bank.
Yeah, this is cheaper than the bank, and the bank charges you interest and principal, right?
Yep.
So in these cases, you're only paying interest, and then obviously it says balloon payments, meaning you're prepaying all the interest in the beginning, right? So we can get creative on the solution. Anything else you wanted to add as when to consider the private mortgage, like what your clients in what situations? I know, for example, another example is pre-construction condos, right? So the buyer, let's say they bought 3 years ago, and okay, maybe not over the last couple of years, but typically the value of the pre-construction goes up over that time. And the bank will only give you financing for, you know, a certain percentage of the purchase price. But say, for example, you bought the condo for 800,000, it's worth 1.1 million. No one's gonna finance you based on the 1.1 million. But if you wanted to, you could close private, right? And then refinance a few months later with the bank at the new valuation. So you can get an appraisal, maybe 6 months down the line or whatnot. You're paying interest only payments. And then eventually you're gonna get out of that private with the bank at the value that it's sitting at currently. So sometimes it's a band-aid, sometimes you can do a bridge, you know, they're selling another house, but they bought another house, and so all these different reasons why. So due diligence, what are you doing as far as due diligence? The main thing, like I said, because these are equity lenders, the main thing is the property valuation. What is the property worth? Because people will ask you, what, you know, how high will you go on the LTV? Well, what if we can go up to 80% based on our value, right? Because if you're telling me your house is worth $1 million, and you know, if I'm part of my condition as a private lender is that it's based on my valuation, which it always is, I can give you 80%, but my valuation is 800,000. So I can, you know, as a lender, I can determine what I think the property is worth. Give you an amount that I'll lend up to 75%, 80%, whatever the case may be. But it's critical to have a valuation of my own, because it's one thing for a realtor to value your property. When a realtor comes to your house, they're gonna try to tell you, you know, yeah, you could probably sell it for this, you can probably sell, because they want your business, right? Oh, yeah, no problem, Abhinav, yeah, oh, you know, the comps around the area are $1 million, but I'm gonna try to get you 1.1 million, right? Cause I want your business. A lender, however, is gonna look at the worst case scenario. If you default, if you're not paying your payments, how quickly can I sell this property? Cause I don't wanna carry it. I don't wanna pay your mortgage. How quickly can I get this thing off my hands? So typically what happens is that the lender will have they're very conservative on the values, because they know that, you know, that's a risk to them. They're not gonna take the higher of the value. So if there's an appraisal, and usually they'll have their own ways to value. I have a one lender that always sends somebody to the property every single time. The borrower is, you know, responsible to pay. They charge a $350 valuation fee. And, you know, sometimes if they have an appraisal, they'll charge less, because they have to do less of the, you know, comps and whatnot. So about $200 to $250. But they'll do their own valuation by somebody that's trusted on their side. So the lender always wants to do that. Obviously assessing the borrower's creditworthiness. Some lenders don't need, you know, specifically a credit check. A lot of them don't need a credit check, but they want to know that you're in good standing. Is your first mortgage in good standing? Is your second mortgage in good standing? Why are you paying out your second mortgage? Are you in default? You know, give me a payout statement. What is your, you know, give me your mortgage statement, give me your, if you have a second mortgage, give me your payout statement. So they do want to know that you're able to make those repayments. And also, again, what is the exit option here? What is the exit strategy? Maybe they're selling another home, or maybe, you know, whatever the case is. Some people I've seen, they're getting a bonus from work or whatnot, right? So they want to know that you'll be able to get out of the situation eventually, because they don't want to go into a power of sale. It's just, you know, just an extra headache, right? Legal fees and this and that and chasing, and they just want to make their interest, make their fees, and every year just continue to roll their money, right? And then fraud prevention measures. This is big right now with even the banks too.
Yeah.
But with the private lenders, a lot of my private lenders will ask, who knows the client? Obviously, like, no, you know, KYC on the bank side, it's a little bit different on the private side. Obviously, you're still checking their ID, you know, you're still making sure. But this is part of the reason why some of my lenders will actually send someone in person that they know. Because I've seen it, and you guys have probably seen it on the news. People will take out mortgages on houses that aren't even theirs. They don't even live there. So this is a big problem. You know, if you're not doing the proper due diligence, and if the lender's not doing the proper due diligence, you can be stuck in quite a pickle if the client is not actually who they say they are. So, you know, they'll send somebody over and see, does this person actually live there? Does their ID match, you know, the address of the property? You know, do they have even access to the property? I was, you know, one of our lenders is gonna come in end of February, and he'll probably tell you the story, but he, you know, there was a person that they did a mortgage for. It was fraud, and they tried to do everything that they could, but it was actually the basement tenant that showed them the property, somehow got access, and eventually it turned out that they were all in on it. But the owner of the house was actually living on top. in the main house, and they were living in the basement. The owner had just so happened to conveniently go on a vacation, give access to the basement tenant to access the top floor, to give the walkthrough of the property, but the mortgage wasn't actually his, the house wasn't actually his. So now they're in a situation, right? So it's very important, and the lawyers will ask, you know, sure, the lawyers will ID them, but there's all these fake documents going around right now that it's tough. So they wanna see them in person, they wanna know you have access to the house. Sometimes as far as evaluation too, some of my lenders will accept a video walkthrough as a, you know, as a valuation. But it always, for example, little things, like it has to have the address. And you have to kind of start the video from the outside, okay, 61, whatever, Main Street South, right? So they'll have to take a video that this is actually the same house that we're talking about. Working with private lenders, obviously, you know, right now you're gonna be working with a lot of our private lenders. Most of you are level 1 agents, so Sam's gonna be helping with that. But in the future, you can build relationships with your own lenders, so, in conversation, you know, if you're going to networking events and whatnot, that's really where I met. Everybody I know pretty much happened through networking. Right, everybody that I've done business with, you know, either it's, even Rex I met through, actually, I asked him to sell one of my properties in Hyde Park, but it's all happening through relationships. So relationships, again, so key in this business. If you have a relationship with someone that you know that lends money, it's a great relationship to have. Until then, you know, we're here to support you, and, you know, we have a lot of private lenders in-house that will be able to do that. Establishing trust and credibility. So with any lender, even on the bank side, with BDMs, what you want to do is get on the top of their, you know, open email from Mike list, because they get inundated with emails, they have lots of deals, and it's really important to be selective on what you're sending to lenders. That's why for now, all the deals are actually going to go through Sam in the beginning. Because the last thing we want to do is bombard different lenders, whether it's on the bank side or on the private side, with deals that don't make any sense. So we're going to help you underwrite your deals here first, and then Sam will determine the situation, which lender is the most appropriate to send it to, and then maintain and build those relationships as you go, so that when they do get an email from Kingsdale Mortgage Center, they're like, yes, we're gonna, never mind anything else on my desk. We know that Sam and Mike and Lexi and I'm like, we know Jason sends great deals, you know, we're gonna make sure that, sorry, I keep saying the same names because I can only see 4 of you. Mike, you're like right underneath me, so I can see your face. So they'll know, you know, they send good files, there's not a lot of problems. You know, they package their files properly, because I have, again, with our lenders, and I have personal relationships with some of them, and they're like, oh, you know, John is constantly calling me, and all his deals are shit, and da 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 da, I feel like blocking his email, so, you know, in the beginning, again, we're gonna help you see if the deal's even worthy of sending to somebody before you just start bombarding people and get on their, like, you know, blacklist, right? And then obviously communication is important, and all of this stuff is gonna be done in-house for now. Okay, I'm gonna hand it over to compliance to Sam, and
Yeah, before to start the compliance that the Ilona tell you about the communication for private lender, that is the very important that the mostly when I will start when I private, I invest my money to the borrow the another people. It's not much how just $50,000. Someone my client call me that they need the second month like their business, right? But the winter time, they are slow, they are frugal about their business. Then they asking me about if you have the $50,000 for the security loan. That's why I just give it to the private myself. That time I was the lender and then broker, right? And then I presented both sides, right? That But that was that is the future, on the might be this year, they started more compliance. But at that time, it was the private deal, right? I say that not private. Private deal is the when you know personally or where you want to be give to money to the someone, right? The loan to the someone, you have to security your side for your side, right? That's why that is the lien by their own property, client own property. So when you have the even friend, wherever you talk to them, that is the more easy to success because private is easier than mortgage, right? Because the mortgage you have to many compliance, even you have to collect all document, whatever. But the mortgage, private mortgage, just to each whatever lender side or broker side, or you have a representative of both sides, right? That you have to make a security yourself. That's why I tell you now is for the more security for yourself or use benefit for your client, benefit for the invest, benefit to borrower, right? That's why I tell you about the compliance. Compliance is you checking about it all processing the mortgage, right? Even the regular deal to submit to the bank, that only you can try get the application, client ID, and income document, and after whenever approved, they get the commitment, right? Commitment, and that when you're done, then you can order appraisal. So order appraisal, so you have to get the report from the appraisal company, right? And addition for file, that is you have to disclosure to client or disclosure to borrower or disclosure lender, right? Private is the when you lender side, you care about lender. If you borrower, right, because your borrower, the borrow broker, right? You can care about borrower, right? They have their diligence. Okay, so the each maybe you have the duplicate like you're gonna be multi representative borrower lender, right? So you can do diligence for the lender borrower same time, right? So you can get both document, both of them, right? But I know about the more interesting is mostly you care about the lender side when you have a multi representative, right? So you care about the lender side more, right? I know about the I have to tell you equally you have to care both, but when you government when you have the audited, right? They're gonna be check of the mostly lender side, right? So you have to care about the lender disclosure too, right? Mostly the private that you don't need the document when you are private. That's why the government the last year issued by that all agent is more than 1 year. They have the testing for certificate. Have to get the certificate until March 31st this year, right? So if you new agent, don't worry about it. You can contact any the senior agent or broker. They're gonna be working with them, right? But if you is more than 1 year, you can apply for the get the a certificate for the level 2. Okay, and when you comply to checklist, it's the same as document checklist, but there are addition. I told you disclosure borrower, disclosure lender, right? Then whenever disclosure lender is what is the risk over the lender side, right? For example, the Ilona already told me about the default, and then you can process in the power of sale. Like when you default, we're gonna be sending the notice to court. This after 9 days, right? Then whenever passed by 95 days, we can order power sale enforcement to the house, right? So whenever they have, but usually when you default to 3 times, like when you pay order like the check deposit, right? So when you have a bounce first time, right? Then we're gonna be notice to them, then they're gonna be contacted their broker or lender, or they contacted that what is the reason today is a bounce. Sometimes I know about when you a borrower going to out of a country, or the business or vacation, because sometimes they don't have enough money on their account, so they do sometimes the check, or sometimes the money go to like same time they're gonna be paycheck that someone get the money, then that is not enough money, non-sufficient fund at the time, then they bounce. But if you bounce 3 times, you can tell your lawyer to enforce, start up for enforcement, that to this. But normally, when they I usually in my case, I just give the chance to the borrower, if we possible to try the sale, or he not enough money or something family problem, then I care about the title of the company, or they remove the name, the change it from the lawyer or lender, then sell after that, right? That is another chance to give to the borrower. So we have to negotiate the lender and borrower broker side, right? So normally when I get the deal from the borrower broker, that I always negotiate it. What is happen? What is the rate payment? What's their financial situation? Something like that, right? So you have to listen from your borrower broker. That is the relationship with your friend or something like that, right? So sometimes monthly, I just check them to how is your client doing or business doing, right? That is your the due diligence for your lender side. If you borrow side, you also check the borrower. Sometimes you call how is it make the relationship, or maybe if we have a problem, you can going to be lender, because sometimes the situation they gonna be good selling for the business, or if the client has the want to try to the B lender or A lender, or at that time the client that had the bad credit, they cannot go anywhere on the A B side, right? Then temporarily, the leaving that. Probably sorry about it, because it's sometimes the network is not stable. So
Sorry.
okay, so mostly you have to benefit for your client, right? So that very important about when you final, you have to prepare all document, and then when you done for the deal, you have to check the compliance checklist. Then you send the all document to me. Then I make sure reviewing that, right? So all deal is the final closing is the compliance checklist, and they send it to me. Then I have the proof. Then you can get your commission. That is the last part of that. But this is the you have to know about the document checklist and compliant checklist. When you start first, that check document checklist for you, and the compliant checklist is the final project. Every deal is done. Then, but sometimes when you a deal, they wherever closing is you done for the everything approved, then you order for the appraiser, everything you get a document, then you can try get closing the compliance first, right? But closing like when you closing is like sometimes someone to 2 months left for the final closing, but you don't care, just make the for at least the compliance check, then send it to me. Because sometimes when you have the time, wherever you relax, wherever, but sometimes you forget about after the bank closing it, right? So I hopefully when you done for your job, whatever you do, then you finish the compliance before that you get the commission, right? So do you have any question for compliance or whole thing like the private mortgage? Okay, start is the next one. Do you have any question?
Okay, I'm gonna run you through a quick sample
Sure.
of a private mortgage, a recent one. Okay, so this is an individual lender. He does not like document. This is probably the quickest commitment letter, the fastest, simplest. There's probably spelling
Two
mistakes
page.
in here. 2 pages.
Yeah,
So it
that's
depends on the sophistication of the lender, of how detailed they are, how they run their business. I like to work with this person because they're available, they're quick, they're flexible, his rates aren't the best, but he can fund, pretty much overnight. So this is, I just blurred out some of the private information. This is a second mortgage. And again, this is basically the terms that will be on any other commitment, but some commitments, and we can show you another one, another time. I haven't blurred out the sensitive information just yet, but you'll see the commitments that we use internally for our other private lenders, but this is just an external one. That you'll see that they're drafted by lawyers, and some of them can be like 20 pages, right? All the fine print, all the things, but this is, I'm using this example because all the information is on one page. So this client needed to pay off some outstanding debt, maxed credit cards. They were in a situation, they kind of let it it's a snowball effect, right? And then they also wanted to do some improvements on their house, fix up their credit because they were so maxed out. So within the next year, they're going to, fix up the house, pay off right away all of their debt, fix up their credit, have a new valuation for their house hopefully next year with clean credit, and then we're gonna refinance them with the bank. So they want a second mortgage for $160,000. Their existing first mortgage, very low, $150,000 with TD, must be in good standing, that's part of their condition. They have a $50,000 HELOC. So HELOC technically, in most cases, is registered as second.
That's correct.
So, meaning your lender is now going in third position technically. The rates between a second position and a third position mortgage are quite different. So, the lender, a lot of the times, they don't care that if you have a HELOC. Some will, have any of your lenders considered it as a?
Yeah, because the client that buying the house is $1 million, but TD gonna be give it to the HELOC 125% for the loan to value of the house, right?
Mhm.
So he got the mortgage, the value was $1 million, right? And he got the mortgage 800,000. But when you HELOC, they give it to 125. No,
200.
$1,250,000 extra. So $250,000 HELOC, right?
Mhm.
So that is over value of the house,
Yeah,
right? Then that's why my lender wondering if he using the 250,000 is like over 100%
Yeah.
of the mortgage, right? So I tell the same as that the closing the HELOC
Yes.
right? And they drop down the loan to value,
Yes.
then we can, consider for the give it to the another like $200,000,
Mhm,
right?
mhm.
So
Yeah, so even if the HELOC is empty, they're always considering it as full. Because those borrowers have access to that money.
that's right.
So even if that HELOC balance is zero, I don't care, because tomorrow, guess what? You can go and take out $50,000, right? So that always has to be taken into consideration. Again, technically, it's in second position. Technically, this would have been a third position mortgage if the HELOC was not paid off and closed. And that's a big, detail that can't be missed, must be paid off and closed. Cause the fact that they're paying off doesn't mean anything, it's still, we're counting it as that's an outstanding balance of $50,000, right? So, obviously this is for a 1-year term, the interest for a second mortgage, 12.5% monthly. And again, here, because the client couldn't afford the monthly payments, they said we could afford $500,000, fine, $500,000, sorry, $500 per month. And so that would equal the $6,000. So the total interest payments, so what, 12.5, and this is where you do some math, right? So 160 times 12.5% for a year is $20,000. Okay, the client, and this is rough math that I do all the time. This is just rough math. So, well, I shouldn't say rough because then it can't be rough, but quick math, accurate quick math, okay? So 12.5%, I'm gonna do it on my phone now. So 160,000 times 12.5%, $20,000, okay? 500 times 12, $6,000. So now the remaining interest is 14,000, and it's gonna be prepaid and deducted at source, okay? Lender fee 3.5%, broker fee 2%. Again, deducted at source. So when your client needs, say for example, there's a big difference between needing $160,000 in hand and between needing $160,000 loan. So this is where you need to, because by the time this person now pays off their 50,000, now you're at 110,000. Then there's like $14,000 in interest, right? Now you're at about 100,000. Plus the broker fee and lender fee, this and this and this. Now all of a sudden, your client thinks that they're getting 160,000, but in reality, they're getting about 85,000, let's say. That's a big difference. Right? So if the client needed $160,000 in hand, now we're adding on top of the 160 to fees and whatnot, and that's gonna change your entire loan to value. So things like that, that's why when it's really close. So this value came in at approximately $500,000. We're gonna, this is conditional upon evaluation, which is the next line. So he's charging $350 for a valuation fee. The value number 10, the approximate value is $500,000 on the subject property to be confirmed by the lender's valuation. In this case, it's 62% loan to value. However, a lot of deals that you'll find are going to be over 70% loan to value. Right? Like a lot of them, right?
Yeah. So
75% or whatever. So when you're that close, this is where your underwriting skills and you start training yourself on, and we'll start training you on how to underwrite something like this. The deal comes in, the client says, the house is worth $1 million. They think it's worth $1 million. Who knows? But of course everybody thinks their stuff's worth the most, right? So they think it's worth $1 million. Fine. I want a second mortgage and it's gonna be up to 75% loan to value. Okay, fine. Now you start doing a little bit of your underwriting and your due diligence. So maybe you're going online. I use House Sigma, for example, just to verify some valuations. And I look at House Sigma is good because they have you can see what's been sold in the area. But for now, we're going to do the underwriting. So I'm skipping forward a little bit just to give you an idea of what you'll be doing. So now I'm looking and all the properties in the area are selling for $900,000. Okay, so there's a discrepancy there, right? So let's say they want 700, let's say their for argument's sake, 500,000, they want 250,000, now we're at 75% of the million, right? And I know, for example, my lenders are only gonna go up to 75% or 80% loan to value. Now we just shrunk that $100,000, right? And that window of opportunity is going down a little bit more. So now let's say, okay, let's meet in the middle. Let's say your lot is a little bit bigger, it's worth 950,000. But they have all these credit card debts, or they have this, and they definitely need that $250,000 in hand. Fine, but now that the property is worth less, and let's say we can only, you know, give them the actual 250, where are the fees coming out? Oh, I can't afford the interest payments. Can I prepay my interest? Oh, this, and this. So once you start adding all this up, and you can do this within a couple of minutes with a pen and a paper, you can very quickly, you know, determine, is this even gonna be a viable file? Because the last thing you wanna do is start wasting time, you know, with deals that are not even close. So then you have to have a conversation about expectations with your client. What's another option, right? If we can't do that, you know, can we do this? Do you have another property that we can tag? Do we have other collateral or whatnot? Because you'll see that loan to value when you see a deal, and even, you know, some agents will send deals and like, oh, this is a 65% loan to value. By the time we underwrite the deal, it's actually 85%. Right? So you'll start learning how to do this, and you know, in the beginning, we'll be doing it for you, and we have the underwriting department doing it. But that's kind of how, you know, this all comes into play. So property taxes, if not up to date, are paid from the proceeds. And these are the standard terms. So standard terms, non-payments, is $350 per check, in-person signing required. Again, for verification of identity purposes. Legal fees, the borrower is responsible for the lender and borrower legal fees. So the lender does not pay for the legal fees. Independent legal review. No additional mortgages, so this without written approval. So sometimes they'll ask that they are allowed to have secondary financing, especially on the first mortgage. Because they already know they're gonna get a second mortgage, so they want that to be removed. And then again, title insurance is required or can be obtained by the lender, so this lender will self-title if need be. Legal retainer, prepayment and discharge, so all of these things, you know, you're gonna need to understand so that you can relay this to your borrower, right? What are the terms, and go over all of this in detail. So that's just a quick private case study. Any questions?
Hello, so I just posted a question in the chat message also. I just want to know if so the lender fees and the brokerage fees, does that get added to the mortgage itself and when we're doing a private lending, or it has to be upfront?
No, the fees have to be paid upfront. But if you need, so like I was saying, that's where the loan to values get messed up. Because if you're, so say for example, you want $100,000 and I'm the lender, right? And the loan to value is already 80% if I give you $100,000. So now either you go into your bank account and pay my fees, and I give you the 100,000, right? Or it gets deducted, the amount can get deducted from the loan amount. So you're not actually going home with 100,000 by the time you pay the fees and pay the legals, and you know, that's where you'll have a statement, a ledger from the lawyer, and you know, statement of accounts that says this is who you paid, this is what the legal fees were, these are what the fees were, you had unpaid property taxes that had to be paid. So but usually the fees are deducted at source.
Yeah.
From the amount.
So for example, sometimes, you know, the borrower that just only have the loan to value 80% mortgage, like for pre-construction someone buy, then they just request 80%, but we have the fee, like broker fee, lender fee, and then like lawyer fee, everything we can top up, like the variable amount that is, so we can negotiate it 84%, right? Actual is 83 and it's 84%. We just give it to that loan, right? Maximum sometimes, right? I know about that they get the pay for the free construction company to the 80% loan, right? Then 3 to 4% we negotiated. Sometimes I know about it, the fee gonna be the too much, sometimes less, or I don't know about lawyer fee, then we all calculate it, then we negotiate it to the lender. If the lender has to agree, then we can give it to the I have a case that is I give it to 85, I give the 85 for the loan. Yeah, something all included, right?
Yeah.
So
Yeah, so
sometimes
basically,
yeah, go ahead.
so basic, okay, can I
Darwin,
speak?
yeah, I hear you. Okay, go ahead.
Yeah, so basically, from what you meant that, it can be adjusted, so the lender fees and the broker fees can be added into the loan amount.
That's
If
right. That's right.
the lender is willing to, negotiate their thing, and the buyer do not have any extra money to pay for the fees, brokerage fees upfront, right?
That's
That
right.
will
That's right.
mostly be the case.
Mostly,
Mostly. Yeah, mostly.
not, yeah,
Okay.
yeah, 95% of the time, that's what happens. It just gets deducted from the loan amount, right?
That's right. That's right.
As long as the loan to value is there. So if you're dealing like this, for example, this deal I just showed you, 65% loan to value, no problem. You need a couple, you need an extra 20,000, you need an extra 40,000, okay, just put it on top. But we need to know, what the client needs in hand, because if they're going and they're actually doing something with the money and they need 160,000 in hand, all of those other fees and payments would have to be added to that 160. Versus now that client's probably only getting 85,000 in hand. So if they really needed 160,000, then that's that can change a lot of things. So you just have to have that clarity from the client, how much money they need, this purpose of this second mortgage was mostly to pay off their debt. So they don't need too much money in hand. They wanted about $40,000 to make some improvements to their house, maybe have another $40,000, just in case in their bank account, but most of the reason why they were taking out that money was to pay down their debt. So in that case, it would make sense.
Even we gonna be negotiate the broker fee, right? So depends on the agent, how they agree with the client, right? Sometimes the lender side, the 1% lender fee, and then broker lender is 1%. But you negotiate your client, but the borrower broker, if they want to be 2%, we're gonna be added to 2%. It's all negotiable, right? So then let us know that when you send a commitment, then we just like the disclosure to borrow, right? So how much the the borrow broker side, the fee, right? So all is the negotiable. So sometimes, I got the 0.5, right? And I give it to the 1% to the borrow broker, right? So we all negotiable. Okay, so let me know when you have done it, that because we make it all happy, even client, me, and then the lender side too, right? So we have the negotiate to set up for the how much they want, right? Then that is the all. I hope that all the involved the people who want to be happy, right?
Yeah, so the fees are negotiable on both
Yeah,
sides.
right.
Sometimes the lender will give us a quote.
Hmm.
And it's too much for the client, but the deal's a good deal, so they're like, okay, I'll bump my rate down by half a point or
Right.
something, right? And same thing, so if you, because ultimately what your job is gonna be is to sell the client on the rates and the fees, right? So, that's part of your job, is to be a salesperson for the lender in this case. And it's negotiable on both sides, but you'll have to have those sales skills in order to present the deal to your client too. And then be flexible, like Sam said, sometimes, okay, so if the client is, in a situation or whatnot, or then you can say, I'll take off half a point off my fee too, let me see what the lender can do. So on the private side, it's pretty flexible like that. Or sometimes they'll be like, okay, my client prefers to pay a higher interest rate than, can you drop your fees and add it to the interest rate? Or can you, if they can't afford a higher interest rate, can you add it to the fees? And so it's, on the private side, it's quite flexible. Awesome. Any other questions?